There's the clipboard right there at the edge of my seat. There we go. Okay, welcome. Thank you for joining us this evening here at Storm Surge. This is our first speaker series for the season, and we're delighted you're here. For those of you who are new to Storm Surge, I am Kathleen Britton. I'm on the board, and we have other board members here this evening as well. There we go. So for those who are new, Storm Surge was founded in 2013 as the threat to our coastline from sea level rise was starting to become a problem to our community. So to address the coastal issues of climate change, we promote science-based outreach and education, including creating original content in video format for use by schools. We encourage you to learn more about Storm Surge and consider volunteering by visiting our website. And we are also going to be circulating a clipboard if you would like to add your name to our mailing list, your name and your email to our mailing list. So this evening, we're delighted to welcome our speaker, Chris Sidoti. Did I say that? Excuse me, Charlie Sidoti. That's okay. Beg your pardon. No. Founder of Insure, an industry-funded not-for-profit with a mission to catalyze novel insurance solutions that support effective climate adaptation and mitigation. Insure accomplishes this by building innovative insurance products that incentivize community resiliency investments. Charlie has 30 years experience in the insurance industry, all with commercial P&C carriers in a variety of risk management related leadership roles. He also spent 10 years working on insurance adjacent startups, ultimately founding Insure in 2019. He served on the board of Insurance Institute for Business and Home Safety, and is a visiting lecturer and advisor to Northeastern University on new insurance analytics and management master's program. We'd like you to just take a quick second to take a look at our, before this evening's program, but to take a look at our program scheduled through the fall. On October 21st, we hear from Wayne Castonguay about shellfishing in the Merrimack River, and on the 20th, Kurt Rogers and Jose Tapia of the Merrimack River Watershed Council are going to share details about water quality of the Merrimack River. So, and you can register to go to those events on our website. I'd like to take a moment to extend some special thanks. The first is to the Institution for Savings for being our speaker series sponsor this year. We also thank Newburyport, the city of Newburyport, for the use of this beautiful space for our meetings. And of course, the NCM Hub, they are filming this for live streaming, and then it will also be available after the event, and we post it on our website as well. And lastly, our special thanks to you for your support. Storm Surge is a completely volunteer organization. It exists because of people like you who share our mission to empower our community with knowledge that's needed to actively mitigate and adapt to our rapidly changing coast shoreline. And we are grateful for your support in so many ways. So thank you for being with us this evening, and I'm delighted to turn it over to Charlie.
Thank you. Mm-hmm. Thank you very much. I'll take 1 second here to see if I can switch the slides. And it worked. Excellent. Thank you very much. Thank you all for coming. Insurability planning, we are going to absolutely talk about how our insurance markets fails. Just quickly, she gave me an awesome introduction, kind of told my whole history. But like what I like to say is that I'm a recovering insurance professional. Insure is a nonprofit innovation hub. We don't build insurance products to sell. We work with the insurance industry and we work with communities to solve some of the insurance problems that I'm going to talk about. We really believe that insurance needs to be reimagined to deal with what is really becoming a crisis. If you look at the high level, one of the biggest statistics that we focus on is that 60% of catastrophe losses are uninsured, which means those losses flow through to either homeowners, municipalities. Historically, disaster relief from FEMA has covered some of that, but not really all of that, and that is changing dramatically. So that there's this protection gap, and flood is one of the biggest ones. The flood numbers are sometimes much higher. At the same time, changes in weather, changes in climate are causing an increase in both the frequency and the severity of storms, which is, part of the story of storm surge, why storm surge exists. And insurance costs are also increasing. All those factors are causing insurance costs to increase, but also just even the accessibility of insurance. Some people can't get insurance, so the availability is decreasing. So this is the problem that we are trying to solve as a nonprofit innovation hub. And what we'd like to do is break that crisis down into 3 drivers. The biggest one is that risk is changing, risk is increasing, the storms are more severe, they are causing more damage, sea level is rising. That core issue needs to be addressed, and a lot of what I'm going to be talking about and a lot of what we hear as communities do planning, there's a lot of conversation about investments into resilience, into adaptation, how do we build, increase building codes so that things can survive more. Those things need to happen. We need to either bring risk down or figure ways to adapt to risk. Nothing in the insurance market can be fixed without focusing on that core kind of risk problem. But having said that, there's also what we believe is a mispricing of risk by the industry and a lack of innovation. A couple of statistics, the insurance industry spends about 1% of revenue on R&D. That is compared to 5% for all industries and 13%, 12 or 13% for innovation sectors. And arguably, insurance industry is an innovation sector. And the R&D that they do, a lot of the companies are large global companies. And they have capital that comes out of like Munich and Switzerland and London and Bermuda. And they think about these big macro kind of mega trends around climate. So they are doing, some of their R&D is focused on hazards like wind and changes in rain and things like that. But what they don't do very well is hyper-local approaches and also very innovative approaches or very new approaches to adaptation. So things like investment in nature-based solutions. So what they tend to do is they quickly and fully capture the increases in risk. But when it comes to large conservation projects that clearly reduce risk, but maybe over a long time period in a large area, they don't know how to apply it to their business model, which is not large areas. It's usually one building, and it's usually not long time horizons. It's usually 1-year policy. So there's like a translation issue. So they're not necessarily capturing the value of investments in adaptation. And then finally, there is just a protection gap. Some people don't buy insurance. Some people can't afford insurance. And those gaps, the people that are uninsured, in theory, it should fall on them. But a lot of times it falls on the municipality, the community, and others. And so those three things combined are caught, they threaten the financial stability of individuals, businesses, and whole communities. So I just thought it was important to kind of break down what's driving this crisis before we get into what we are trying to do. We envision an insurance market that really works for everyone. And we want to enable individuals, communities, the communities to manage financial risk in the face of climate change, financing risk. When there is insurance in place, it is really one of the most efficient ways to deliver capital into a community following a catastrophe. So it is cheaper than other methods of financing risk, but it needs to be in place. So achieving our mission and the vision of making insurance work for everybody means that we are closing protection gaps, insurance protection gaps, and we are doing it in a way that facilitates community resilience, investments into resilience. There should be a dividend associated with if people, whether it's individuals or communities, invest in things that reduce expected losses, there should be a payback in the way that insurance is delivered. We also do work on the energy transition. There are protection gaps related to new technologies related to renewable energy. I'm not going to talk about that too much, but certainly if you have questions, the same insurance protection gaps that threaten communities, as I described, are also slowing the adoption of energy, new energy transition technologies. And a lot of the opportunities to reduce risk are related to nature positive practices, and those are largely not understood in terms of how they shape risk and reduce risk or contribute to risk if they're not managed properly. In the way we achieve our mission, what we try to do is work with communities on what we call insurability planning. What we try to do is get community leaders, when they're working on economic development planning, and you're seeing a lot of communities now are investing in resilience plans where they are working to reduce loss costs, have better building codes, invest in infrastructure, land use. Those are all things that can reduce risk. There is a general belief that investments in those areas will quickly and fully and automatically translate to better insurance markets. Sometimes that's true, but often it's not. And so what we are suggesting and what we are working with communities to do is say, you really need to not just invest in resilience and think about the physical risks, but also think about how you can go the next step and shape the insurance markets so that you get the insurance that recognizes the efforts that you've made on investments, understanding your own risk and managing your own risk. And what we're trying to do, and we'll go through some specific projects that we're doing right now, but work with communities to create test beds that support innovation in insurance and insurability planning. And as we work with communities, we identify opportunities to really reimagine what insurance is. And I'm going to talk about the areas that can be innovated. There's a lot of them. But we take those back to the players in the industry that are willing and open and interested in innovating and create new products and services, and help them to create products and services that actually meet community needs, working with specific communities on specific perils related to specific populations, figure out how we can create new solutions that solve real problems, and then bring them to those communities that we're working with as a innovation test bed, and then scale it from there. And we're pretty early on this journey. We've been doing this since 2019, but there's a lot of work to be done, as you can imagine. So just quickly, I like to talk through what I basically just said, but talk through a specific definition that insurability planning, because everybody says, what's insurability planning? I'm not sure what that is. But it's a community-led strategic process to improve the community's access to affordable insurance. And it's achieved by proactively identifying, managing, and mitigating risks. You have to manage the risk first. But in addition to that, going the extra yard as well as intervening in the local insurance markets to create the market conditions, the favorable market conditions. And there's a lot of ways you can intervene in insurance markets. It can be regulators can intervene. Procurement is a way to intervene. You can group purchase insurance. Like you could do property insurance is mostly sold individually from a company to an individual. But we are talking to some insurance companies, to some businesses that are thinking about group purchasing it as a benefit for their employees and getting the procurement power of the corporation, or the municipality could think about ways to group purchase insurance. You could also do it in a collaborative way, and we do this quite a bit, where we go to the industry, we know the industry pretty well, to say, hey, we're working with community X, we need an insurance solution that solves this problem. Can you help us do it? And if you do, you will have a marketplace that will be open to it because we know their problem. So it's really kind of those two things, managing the risk and then actually trying to shape the market. Quickly talk about areas where insurance can be innovated. Insurance is a very old industry and doesn't, quite frankly, innovate a lot. So insurance hasn't changed a whole lot. Sometimes some products go back hundreds of years, but you can definitely create new products. And new products are like parametric product is a new insurance product that instead of being triggered by damage to an actual building, you can use proxy variables like wind speed to actually trigger a payment. So if the wind goes over X or the rain depth goes over some depth, you could trigger a payment. And the benefit of that is you can flood money into a community within hours or days. So very quickly you can see that, the rain gauge at the weather station went over the trigger mark, and you could trigger a bunch of payments without going to figure out who had what type of damage. So that's one type of product innovation, micro products that are very small products often for vulnerable populations, for renters, things like that, could be created and are being created to fill very specific gaps. New types hazards like extreme heat could trigger a number of things like wage replacement for people that maybe should be working out in the heat, but it's too dangerous to work outside. So instead of forcing them to work outside, you could create a wage replacement product that covers their wages on days where it's dangerous to work. So that is one area of innovation, is new products. Procurement, group purchase at a community level, at a lot of different areas where you can leverage the procurement power of somebody to create the favorable market conditions that we talked about. Then you start getting into bigger things like the insurance industry. A lot of the capital comes from these global capital centers that I mentioned earlier, Munich and Switzerland, London, Bermuda. You can align capital in different ways so it's closer to communities. One of the things that we observed is that there's these things called community development banks that have figured out how to lend into communities in tight alignment with economic development plans for a community. And often the lending strategies look very risky from somebody who doesn't understand kind of the relationship between the banks and the community leaders who are doing the economic development planning. So some of these loans look risky, but they generally do extremely well because they understand the community. They are close to the community. It is very difficult for the insurance industry to back insurance products like that might be hyper-local kind of connected, because the capital comes out of these global financial centers. So we think there's an opportunity to create new type of reinsurance that is more regional, closer to communities, more mission-driven. A lot of those community development banks are nonprofit, and they are mission-driven to support economic development. There's no reason that same model for community development financial institutions could not be used for insurance as well. Technology, there is a lot of technology, including there's a lot of investment into risk models that are more precise, quicker, but there's a lot of technology, monitoring technology, that really could be embedded in insurance products to make them more responsive to very specific challenges that a community may be facing. And then finally, a lot of innovation could happen around some of these equity issues and challenges. One of the things when we look at communities, people often kind of, when you start talking to people, sometimes these equity issues come up and say, they get characterized as people chose not to get insurance. Shouldn't they be responsible for the consequences? But sometimes when you really analyze, there's issues of could they afford it, but there's also issues of if parts of the community get wiped out in a fairly significant way, those effects cascade to all parts of the community. So it's not just an equity issue. It is, in many respects, communities are in the same boat. And you need to kind of manage the total cost of risk across the community so that the community can survive. And the catastrophes are getting large enough and frequent enough that this is becoming an existential issue for whole communities. Even large cities like LA are dealing with, catastrophic events that dramatically are reshaping the face of, the wildfires out there dramatically reshaped kind of how that city operates. So there's a lot of opportunity for innovation, but it requires, some R&D investment, and we believe it really requires a community-up approach. We think the insurance industry is going to change, and it already is changing dramatically, but what we worry about is that it will change based on kind of large national, and potentially federal approaches that don't necessarily work for everyone and maybe don't work for anyone individually. And we think a community-up innovation strategy is crucial. And we think a community-up innovation strategy, from our conversations with local communities, it is really scary at first because people mostly tell us the first thing they often say is, well, we don't really understand insurance. Insurance is kind of opaque and challenging. But then when you really get into kind of planning, what communities are good at is economic development planning. And now they are getting better at resilience planning. And it's those same core skills that are required to do kind of taking it that next level to insurability planning. And we think there is an opportunity in general, but especially for states like Massachusetts that have led innovation historically and have specifically led innovation in things like health insurance, to lean in and support a community-up innovation strategy that reshapes an insurance market that works for everyone. I'm going to talk through a few projects that we are currently working on, and then we'll open it up for questions. But one of our projects is in Salem, Massachusetts. the community came to us and they said they had an idea for a home resilience audit that was modeled after the energy audits that are done by the utility company. But what they wanted to do is capture the value of any activities that were done by homeowners and by the community, investments into resilience, to quickly and fully capture the value of the investments. And what we're working with them is to do it in a way where they are looking at their total cost of risk, not just the expected losses, but any investments. And we define total cost of risk as it really includes four things: the expected losses that will flow through just from the damage from storms, any investments that the community makes in adaptation or efforts to reduce risk, any investments required to finance risk through the purchase of insurance or through other mechanisms, including disaster relief and emergency response. So those are the things that make up the total cost of risk. And if you invest in one, they often change the other one. So it's a dynamic formula. You invest in risk resilience, the cost of losses goes down, and the cost of insurance should go down. So we're trying to build a framework to help both homeowners and the community think about what the trade-offs are on different types of investments. So not everything is just a pure engineering analysis, but it is looking at this total cost of risk the way you might look at the total cost of ownership of a vehicle. So we're doing that in Salem. It's really home-focused. We have a proposal into the state supported by Plymouth to do almost exactly the same thing, except for focused on the businesses, the small businesses in their downtown area, which is a little similar to Newburyport, right on the water, beautiful. So we would have instead of a home resilience audit, it would potentially be a small business resilience audit. And then the state of Massachusetts is looking at language to incorporate into the environmental bond bill that says basically that insurability and insurability planning is an actual thing, and that could be considered when you're doing resilience projects to think about that next step that I talked about earlier. We're also doing a project in Narrows, Virginia, which is in coal country in southwestern Virginia. They have been flooded a number of times, riverine flooding, so the rivers rise very quickly. And specifically in Narrows, their wastewater treatment plant flooded twice. They are looking at three options, or actually four. There's a do-nothing option, but they could repair it and harden the existing wastewater treatment plant. They could move it to somewhere else in the town, or they could shut it down and turn it into a pumping station to a neighboring community's wastewater treatment plant. Each one of those has different cost profiles, and each one has different risk reduction profiles. So we are helping them to think through what is the total cost of risk across different populations over long periods of time to make a decision that would be optimal across both the engineering and the risk transfer piece. In California, the California Department of Insurance is investing in home hardening and defensible space related to wildfire. They believe, and initial evidence shows, that their estimate of the risk reduction is different than the way the insurance industry looks at it. So we are trying to work with them and some insurers in the market to say, why aren't you recognizing the risk reduction in the insurance markets? How can we get more insurers to come in? How can we make them understand the value? Or, the evidence might show that maybe the value isn't there, and how can we work with CAL FIRE to make sure that the value is there? But there's probably some combination thereof. We're working with an economic development firm to help Honolulu revise their resilience, their 5-year resilience plan. In the existing plan that we looked at that was done, I think, 5 or 6 years ago, the first few pages of the old plan had these analysis of different types of scenarios, and it said the loss expectancy for a typhoon is X tens of millions or hundreds of millions of dollars, and it went through a bunch of different hazards, and it said there was a loss expectancy number associated with each of them. And then it had about 50 pages of possible actions the community could take to respond to those threats. And then it had a prioritization process that was essentially a voting kind of process, like, what do you think should be our top priorities in terms of actions? And one of the things we suggested is that you did a lot of really good work calculating these loss expectancies. How can the different actions, how do they affect? It should be more of a scenario analysis that says, we believe that this action would affect this loss expectancy by X amount, and have put dollar numbers and cost numbers to the prioritization process. It's not always easy. That's probably why they didn't do it. But where you can do it, it provides kind of a framework for decision making. And nothing we're saying is necessarily going to make things perfect, but the more you can make it kind of tied to specific impacts, the more you can, strengthen decision making across some of these planning issues. And then finally, there's a project in Anne Arundel County, or Annapolis, Maryland. They are looking at certifying the compliance with building standards that are higher than the code requires. So they are building a certification process for individuals to get certifications if they go above and beyond the existing codes. And we are working with them to design the certification so that it is easily consumable by the insurance industry. And we are working with the insurance industry to help them recognize it and provide more affordable, more accessible insurance for those who go the extra yard. So there is this dividend to compliance with higher levels of standards. So that's what we do. That's how we do it. I'm sure there's maybe a lot of questions. Maybe there isn't. Maybe there is. But questions about how insurance works related. Everything we do is related to climate change. I'll open it up for Q&A now. I'll repeat the question, yes.
Could you talk a little bit more about the process, how you translate the benefits of remediation efforts to insurance companies' premiums? What do you tell them? Who do you go to? I mean, there's like thousands of insurance companies, so
Yep.
And may not be you're talking to the one that's not my insurance company. So how do you translate that into something concrete for policyholders or communities?
So the question was, how do we translate risk reduction efforts into things that the insurance company can use for, and recognize in their insurance premium? And one of the comments he made was, there are thousands of insurance companies, which is exactly right. And the thousands of companies also, there's like a scientific piece to risk pricing, but there's also a corporate kind of appetite for risk. And an example that I use is, I worked for a large company that was a global company, and we insured half of the market on the Cape Cod and the islands. But then we divested some of our business, and we sold off probably more than half the business and shrunk down to a New England, New York, New Jersey, Northeast company. We didn't insure anything different on the Cape and Islands, but it was a much bigger piece of our pie because of the things we sold, which our risk management people said, you need to non-renew half of your business on the Cape and Islands, which the people on the Cape and Islands said, like, why? The risk didn't change. Nothing from their perspective changed. So that was kind of a change. So it is definitely a challenge. And what we try to do is map out, when we work with a community, is one, map out who is already in the market. Usually, although there are thousands of carriers nationwide, in most communities that number is much smaller. And then within that pie, who are the ones that are innovative? And then outside of that pie, who is innovative and interested to coming into that community? And oftentimes it's difficult for a new insurance company to come into a community without a pathway to come in. So when you're working with a community and they are saying, we need a product or we need a solution for a specific problem, we can sometimes find the company that is kind of aligned with that, because this is what we do every single day. And then, help them come in a way that really helps the community. When you get to some of the technical things, we partner with universities, we partner with some very sophisticated like flood modeling companies that are doing some really cool things around, very precise modeling. So we speak a lot at both conferences, and it's not always easy, though. Your point is right on.
And then if you do get an insurance company to consider a deduction or a discount or whatever, all of that has to be approved by state regulators.
We exactly right. I mean, insurance is a very challenging thing to be a startup in. You have to get regulatory approval. You have to actually raise money if you're trying to do a startup small company, you need to raise money to run your business like any startup would. But then you need to get typically a large reinsurer or somebody to back your losses, because small companies don't have balance sheets to be able to pay claims. So they need to convince investors to invest in them and then convince reinsurers to provide them loss capital. So it's very challenging to do these things, but they have, companies have kind of done it, and there's a real need for it now, and we are trying to incubate and accelerate startups, and I think there's a lot of opportunity to do some great stuff.
Yeah, I live in Ipswich, and we are looking to develop a number of ways to educate people in town regarding what their threat is, what they can expect, what they should know about resilience, what they should know about a whole range of things. Is it reasonable for a couple of citizens like you sitting here to actually do a little research project on what the insurance situation is in town? How many people have homeowners insurance? How many people don't? I mean, is there a database at the insurance commissioner's office that we could actually end up with, some information? Does everybody go through the local insurance guy downtown, or, that kind of thing?
So I'll repeat the question for the TV audience. The participant asked a question about, is it reasonable for citizens in a community like Ipswich to do research about the local insurance market? Where would you go? How would you do it? It is not easy, but I love that question so much, because that is some of the hard work that needs to be done. And it is hard it's hard to do it outside. If you really want to do it, let's have a conversation and we'll connect people with universities. Some of the universities are looking at these things, and also we have had questions from regulators around the particular question. One of the particular questions is, I show that first thing, 60% protection gap. That is like a national number across all perils, and at a local level, community leaders often ask us, like, where is the protection gap in Ipswich or Boston or Newburyport? Like, nobody really knows. And that is one of the key things. If a community is going to do planning, we need to have local insight into what exactly that protection gap is. and no insurance company knows because it is across multiple insurance companies. But the people that know the closest are actually the lenders who are capturing kind of insurance information from multiple carriers across a community. But even they have challenges because there's different lenders as well.
Community government would you work with to have a local planning?
So the question was, who in community government would you actually work with? It varies community to community. We typically often work with people who are doing infrastructure projects, economic development planning, land use rules, where can we build, how do we build, building codes. That is a typical municipality kind of engagement when we talk to people. But we have also got engagement from developers who are building kind of sections of town, and they're working on development, and they want their developments to be more resilient than their competitors, and so they are asking questions. So and there's also like subsectors of types of like housing, people who are involved in housing kind of development and affordable housing are very interested in what we're doing. So it can change, but typically people actually doing economic development planning and infrastructure and land use.
Hi. Could you say a few more words about the Mass Ready Act? That's something we're working on right now at the State House. And I just wondered, what's the language and what do you hope it does for the state?
So, and I am not, I would say I'm not a lobbyist or kind of an expert in some of these things, but the Mass Ready Act is going to unlock a lot of funding for resilience projects. And I know the state has also kind of cataloged, I think, 120 different types of projects, and they are trying to put like best practice in place. If you do this type of project, here's at least a starting point on how to do it. And so the funding is going to fund both the planning at a local level and the actual projects, which could require lots of investment. And what we are suggesting is, what I said earlier, is that both the planning and the work of the project can be prioritized on how it impacts insurance markets, and vice versa can be designed to shape insurance markets, and actually efforts can be made to engage with the insurance industry. So we are trying to get some language into the bill that basically says insurability planning is a real thing, and it should be within scope of a lot of the types of projects that they are looking at.
It sounds a little bit like a highly protected risk market. Who does the audit, or are you the auditor or doing the audits for these small businesses and these homeowners?
We are definitely not an audit, and I did at one point work in a highly protected risk group at a large insurance company. But I forgot to repeat the question. So the question was, it sounds like a highly protected risk, which is an insurance kind of approach to markets. And then he asked, like, who does the audit? Are you doing the audit? There is and especially on things that change, some things when you build a structure, like the location of that structure is always there, and that doesn't really change. But when you do things like around wildfire, well, you cut back vegetation and you did certain things, those things do need to be audited because they change. Vegetation grows back if you don't maintain them. What we're seeing is the verification process can often be done, not always, but what you're seeing is a lot of technology providers are providing verification kind of technologies, including like satellite things, and the industry uses a lot of satellites to see who's got the old crappy roof versus the newer, better roof. And so verification is being done through a variety of techniques, including technology.
Do insurance companies actually consider like, building codes and zoning?
Yes, and it varies company to company. Oh, so the question was, do insurance companies consider building codes and zoning? They usually overlay, the answer is yes, they do. They usually overlay their own models, but one of the things, they look at the degree of rigor in the code, but they also look at the how the enforcement is. I think they have looked at some areas that pass very rigorous kind of building codes, but had lax kind of enforcement, and found out that, well, maybe it wasn't installed or implemented the way they imagined. So they do look at both, and what they also try to do is supplement kind of code compliance with other data that they can bring in, sometimes directly from the policyholder, but also from third-party sources. The best companies are trying to get as much data as possible and accurately reflects the risk, where others are kind of less rigorous, quite frankly.
Is that at the community level or is it state level?
So some things are done at the community level. You're seeing flood, like the NFIP has done flood community rating, and NFIP is the National Flood Insurance Program. There are there are some private insurers which are developing private flood solutions. There's a belief that the National Flood Insurance Program is not that precise, so some people are overpriced and others are underpriced, and there's a private market trying to capture, to create the discounts for the people that are overpriced and bring that end down at least. And you'll see that evolve. That'll probably make the National Flood Insurance Program more unstable in terms of its financing.
I think you spoke a little bit about the aggregation of like purchasing power to be able to like manage premiums. Could you say a little bit more about that? Like, is it only corporations? Have you seen communities and others doing that as well?
The question was, I spoke earlier about procurement and purchasing power to shape markets, and is it only corporations or have communities done it? There have been a handful of pilots of community embedded insurance or community purchased insurance. They have mostly been funded by philanthropies working with communities to do a group purchase for people in the community and leverage the power of communities. In the Narrows, Virginia project that we are doing, we are recommending that they could potentially use the relationship of the wastewater treatment plant with the community members to potentially do a group purchase and embed it in the relationship with the water purchasers. There's a lot of hurdles to get through. This is a relatively new area. There are also corporates that are doing it, thinking of it like a benefit. I think there's some hospitals that have a lot of employees who are saying if we got like a small bit of micro insurance for everybody, that would help them as a corporation and also help the community in which they operate. That is a newer area, certainly on catastrophe insurance.
I have two questions, and they're not related. So the first one is, can you say a little more about the Salem program? Because I think resiliency audits would be of interest to Salem's very similar to Newburyport, has a lot of the same issues. How is that working? Is it just getting started, and do you anticipate people who go through those audits to get some kind of a discount on their insurance, or can you just explain that program a little more? And the second question is, at the municipality level, I could be wrong, but I think
our city self-insures pretty much all of our infrastructure. We don't have insurance on the wastewater treatment plant or the water supply. And if we got a major catastrophe and those things were taken out, it would be a huge cost. So do you work with municipalities to kind of assess where insurance might be able to improve their financial plans?
So, 2 questions. The first one was about this, the resilience project in Salem. So could we provide a little more information, which yes, I can. And the second one was related to how do communities and do communities insure infrastructure. So on the first question, it is early in the design process. It is part of our job and our mission to help them identify the items that are in the resilience audit in, say, this is Salem, Massachusetts. So they need to choose which factors they would recommend. What are the top? And they're not going to do like every possible intervention that a homeowner could do at the beginning. They're going to try to pick the ones that are, I think, the highest impact and the lowest effort that they can kind of bring to the community members. So the audit would identify things potentially like raising mechanicals from the lowest level to higher level, all the way up to potential if you wanted to raise your home. One of the really interesting one is rainwater capture with smart kind of technology and investment in landscaping that will reduce runoff, which has an individual impact on the home, but also if you get enough people to do it in the community, you could have community level favorable impacts, like they wouldn't have to increase their stormwater system as often or as early as maybe they would otherwise. So, and we are working with them to bring insurance providers in that have more sophisticated flood rating models that could capture the value of some of those things. We are also working with them to potentially use higher fidelity flood modeling so that, and I don't want to get into flood modeling, but there's very high fidelity and there's lower fidelity modeling so the higher fidelity one might be able to kind of identify that, hey, these homes here, this curb that, is kind of causing some of the runoff to flow in a certain way is causing some significant problems for a subsector of homes. That could be an opportunity to change. Again, we're always looking for high impact, lower investment, lower effort interventions. So helping, the community to use the higher fidelity solution providers on the hydrological modeling, but also bring it back to the companies that have that same level of sophistication and can recognize it in the insurance kind of provision to say, yeah, you're right, that does reduce risk for those homes, so we can at least get to the subsector of ones that might be lower. You are exactly right on infrastructure is often not insured. And we know from the kind of experience in Narrows, Virginia, that it is a significant problem. There needs to, and we're not necessarily saying that insurance is the solution, but there needs to be some financing for infrastructure, because these same things that are affecting homes and businesses are affecting infrastructure. The state of Maine is looking at a study to say infrastructure, including their ocean infrastructure, docks and other things, half of which is owned by the public sector, and then half of it which is owned by private owners, threatens not just the assets but the economy in different ways. So we think the same approach that we say is you need to look at the total cost of risk and figure out how to finance these things. And maybe it is through kind of rainy day funds, disaster relief, but there needs to be funding, and it needs to look at the likely frequency and severity of impacts to the specific infrastructure. That is a huge challenge going forward, along with a lot of these climate challenges.
Yeah, I have two questions. One is, what is your business model? Or are you a consultant, and who's your ideal client?
So one question was, what is your business model? Are you a consultant, and who is your ideal client? On some days, we try to figure this out, but we definitely do consulting. We do consulting with communities. We are trying to build some technology to that we can pass off, so we don't need consulting projects all along. So some of these things, and as we are doing consulting projects, we are trying to build tools so that communities can kind of do some of this total cost of risk analysis themselves. We are trying to also build data sets, and not really a data company, but we are trying to build information kind of knowledge bases that communities can lean into, kind of the things we're talking about. Because most everybody is either like, I really don't know what you're talking about, or I totally know what you're talking about, but I work for an industry that is selling insurance, and I'm focused on managing the balance sheet risks of the large insurer as opposed to the community. So I think we are uniquely in the middle.
Great. Thank you. My second question is, when you find communities that want to reduce risk, and a lot of communities are, do you find that the insurance companies are willing to reduce their rates? I mean,
so the question is, I think, the million-dollar question. When you find communities that are investing in risk reduction, do you find that the insurance industry is willing to reduce rates? The answer is generally no. And it is why we say that you need to, and I take that back. There are some very specific examples where the answer might be yes, where they have very known things like, oh, you changed the flood zone, and the flood zone changed from this to that, and they recognize, they can quantify it, they understand it. The same with like fortified roofs, where the industry has done a lot of research on the IBHS roofs that are fortified. And there's a few other things. They don't want to be necessarily overpriced, but they think on average that risk is either fairly priced or underpriced, and they are not doing the work to quantify the differences in risk at a more granular level. But what we do find is that there are some insurers that are willing to kind of be competitive and take the time and effort to understand the risk reduction that a community might be doing. And they are super excited to work with us, and they are like, we can capture market share in a way that saves people money and lets us run a good business. We are never advocating for underpriced insurance or just drive rates down because people can't afford it, because that would signal like, hey, you can live anywhere in any type of... We want risk to be priced accurately, but we don't think it's being priced accurately, and we don't think the industry is necessarily investing in the R&D to price it accurately. We think it is a business opportunity for some insurers that are willing to jump in, and it is an opportunity for communities to work with them to bring more affordable, accessible insurance to their constituents. We run out of time?
I think so.
Okay.
Any minute, but
Thank you all.
If you have any more questions, meet at the cookie table, and I'm sure. Thank you, Charlie.
Thank you so much.
Thank you.
This was great.
Thank you.